Hello, hello, welcome everyone. Welcome to Investor Education Program, and here we are going to deal with good futures. So you'll all be in listen and view only mode. So if you have any question, please post it on Q&A section. And before going to good commodity futures, we'll just have a overview on commodity derivatives ecosystem first. So coming to evolution of commodity exchanges. Commodity exchanges in India are dated back to 19th century. It started with Bombay Cotton Trade Association, which used to deal in cotton mainly. So even globally, it dates back to 18th or 19th century, and followed by Bombay Cotton Trade Association in early 20th century. Uh, trade used to happen in jute and oil seeds, and in 1953, the Forwards Market Commission have been established in order to regulate the commodity derivatives market. So, in due to many other issues, in the later part of the 20th century, commodity derivatives have been banned, and in 21st century, early 21st century, government started uh, to extend the government started opening up the commodity derivatives market again. It have given a list of commodities that are being traded that can be traded in the derivative segment in India. And in 2003, few national level commodity exchanges have been started. And in 2015, SEBI have overtaken Forwards Market Commission, and SEBI has become the regulator for commodities derivatives market also. So SEBI is the only regulator, sole regulator for all the exchanges that are present in India. It's whether equity or the commodity exchanges. And coming to the structure of commodity exchanges in India, we have NCDX, MCX, ICX, NSE, and BSE. These are the important national level exchanges in India. NCDX deals with the agri commodities. MCX deals with non-agri segment, that is metal, bullion, and crude crude oil segment. These are mainly dealt with MCX, and NSE, BSE. You know that it deals mostly in the equity market. So all these national level exchanges are regulated by SEBI, and SEBI comes under Ministry of Finance, Department of Economic Affairs. And as I've told you, in 2015, SEBI have overtaken FMC, that is Forward Markets Commission, and SEBI has become the regulator for commodities derivatives market. So from there, it have taken good measures in order to develop the commodity derivatives market. In June 2017, SEBI permitted options in the commodity derivatives, whereas in whereas before that, before 2017, commodity derivatives segment only has futures in it, and SEBI also permitted category 3 alternative investment funds. That's nothing but a hedge fund or a fund which have short term perspective, that is like it is more interested in the short term returns. These kind of funds are permitted to trade in the commodity derivatives market. And in 2017 September, SEBI permitted that is integration of equity and commodities market arms of broking. That is, if a trader want to trade in both equities and commodities market before September 2017, he have to open two separate trading accounts for both equity and commodities market, because the broking firm has two arms of it, which deals in the equity, which deals separately in equity and separately in commodities. Now it's one and same. So with a single trading account, he can trade in both commodities as well as in equities market. And SEBI also permitted banks to be as professional clearing members, who is a member of clearing corporation and helps in clearing and settlement of the trade. So in September 2018, FPIs, that is foreign portfolio investors, are also allowed to hedge their risk in Indian commodities market. And in March 2019, mutual funds and PMS are also allowed to participate in commodity derivatives market. And in 2019 June, SEBI allowed to have commodity indices that are tradable commodity indices. So NCDX have also recently started AgriDex, which is a tradable commodity index, that is agri index mainly. So these are the listed commodities that we have. It varies from cereals and pulses to oilseeds, spices, fibers, guar complex, and oilseeds. In cereals, we have bajra, barley, chana, etc. And in spices, jeera, turmeric, coriander. In fibers, it's mainly cotton complex and guar seed and guar gum. Apart from that, soya bean, soya refined oil, mustard seed, castor seed, CPO, and sesame seed. And coming to the differences between the commodities market and financial markets, that is commodity derivatives market and financial derivatives market. Commodity derivatives actually deal in actual deliveries, that is physical delivery of the commodity, whereas in financial derivatives that doesn't happen. They are only cash settled. And coming to quality and quantity differences, there yes, they exist in commodity derivatives but not in financial derivatives, because in commodity derivatives, if we take an example of any commodity, commodities have different qualities and different grades that are traded or that exists in the market. So the quantity and quality differences exist. And coming to costs, holding costs for commodity derivatives include assaying, warehousing, and insurance costs, whereas for financial derivatives it's only the interest costs that exist. And the commodities markets are mainly seasonal in nature, because the underlying is obviously agri commodity or any other commodity. So in cash markets that doesn't happen. And the factors that drive the commodity derivatives market or influence the commodity derivatives markets are demand and supply of the commodity, import and export regulations, and government intervention that is present in the uh, in that particular commodity. Whereas in financial derivatives, it's global and local economic conditions, performance of that specific entity or the company, and the taxation structure. Mainly, it's corporate tax. So, coming to the commodity good, we have will deal with all this. That's the production, seasonality, value chain, futures contract, and annualized volatility, depending on taking the spot prices into consideration. And sorry. So about good or jaggery, it is the uh, it is the product that is derived from sugarcane. So India is the largest producer of jaggery in the world. It produces almost 60% of the global production. The global production is 13.6 million metric ton, out of which 8.17 million metric ton is produced by India. And though India is globally the leading producer of jaggery, Brazil is the major exporter of jaggery, and US, China, and Indonesia are the largest importers of jaggery. So, coming to India, in 2017-18, the production was 4.5 million metric ton. In 2018-19, it skyrocketed to 8.17. It's almost doubled in 18-19 compared to 17-18. It's because of it's mostly the demand driven production. And the major producing states are obviously the the sugarcane belt or the sugarcane producing states. That's Uttar Pradesh, Maharashtra, Karnataka, and Tamil Nadu. These states together combinedly produce 80% of the total jaggery in India, and Uttar Pradesh alone contributing slightly less than 50% of the total production. And as good is a derivative or is derived from sugarcane, the production cycle is obviously dependent on the sugarcane. The harvesting of sugarcane happens from October to April, and here this This data shows the arrivals of the good in the market from 2013-14 to 18-19. Here you can see Uttar Pradesh is the major uh, contributor of good. This information have been taken from AgmarkNet. And coming to the value chain of good, it's typical agri commodity value chain. Good is not an exception in it. It's same uh, for even good. So farmer, aggregator, processor, and retailer. This is these are the value chain participants. Farmer does production, harvesting, and storage of the commodity, and aggregators they transport uh, the commodity from they collect the commodity, they aggregate it, and they transport from farmer to processor. And processor processes the commodity, they make the jaggery, and they label and pack it, and marketing is done by the retailers. And what is the necessity of the good futures contract? A futures contract generally mitigates the price risk. As I've told you, in 2017-18 to 18-19, the production almost doubled. So the demand and supply gap always exists in the market, which creates the price fluctuations. So in order to mitigate the price risk that is existing in the market, futures contract in good is really required, and good is mainly used in feed. So the overall feed costs also increases or decreases with uh, the price movement of the good. So, in order to reduce the risk, it's important to have hedge using the good futures contract. So, on the basis of, and as we know, good is produced in huge quantity, that is almost 80 lakh metric ton. So, it's a huge commodity and it cannot be controlled by a single entity or or a group of people. So, this is not a hindrance or any uh, there is no hindrance as such for good in order to introduce into the commodity futures market. And as we have discussed the volatility in the prices, that is the main thing or the core because of which the futures market exists. And see the spot prices trends. We have from Jan 2005 to Jan 2015 here. In 2008-9, the prices almost doubled from 1500 to 3000 per quintal. And from 2009, you can see the ups and downs. That is the volatility. The ups and downs are more post 2009 than pre 2009. So the volatility in the last 3 years is, that is 2018-19, 17-18, and 16-17. The annualized volatility of good is 17.5, 19.2, and 19.2. So it's a highly volatile commodity. And futures contract design, these any futures contract have a basis center, additional delivery centers, contract specifications, quality specifications, and launch calendar based on which the trade happens. And we will discuss all in detail in the next coming slides. So, as we know, any agri commodity have different qualities and different grades. So, which quality or which grade is to be traded is more important. So, uh, in order to decide which quality or what quality and which grade of commodity is uh, will be traded in the exchange is decided by a basis center. So here Muzaffarnagar is decided as a basis center for good futures contract because Uttar Pradesh is the largest producer of good, and Muzaffarnagar is the big production center in Uttar Pradesh, having many processing centers. And obviously because of processing center it's have good infrastructure, and also so it is considered as the benchmark center for discovery of good prices. And coming to contract specifications, the ticker symbol is good, and unit of trading is 10 mt, 10 metric ton. Delivery unit is also same, and maximum order size, that you can quote once is 500 MT, and quotation or base value, that is rupees per 40 kg. You can you trade for a lot, but you quote for 40 kg, and tick size is zero point 0.5 rupees. Quantity variation is plus or minus 5%, and basis price is ex cold storage warehouse Muzaffarnagar, inclusive of local taxes excluding GST. And delivery logic is compulsory delivery, that is, upon the expiry of the contract, all the open positions that are present shall uh, result into compulsory delivery. That is, all the open positions at expiry shall delve into physical delivery of commodity. And due or expiry date is nothing but 20th of, generally it's 20th of delivery month. If it happens to be a holiday, then immediate preceding day will be the uh, preceding trading day will be the expiry day. And coming to quality specifications of good, uh, there are various parameters like sucrose on dry basis percent by mass is 75 to 80%. This is minimum. And reducing sugars percent by mass is 10 to 15% maximum. Moisture allowed is 10% maximum. And SO2, that is sulfur dioxide, percent by mass is 150 parts per million maximum. Water insoluble matter percent by mass is 1.5% maximum. Sulfated ash percent by mass is 3.5% maximum. Ash insoluble in dilute HCl percent by mass is 0.3% maximum. 100% dry golden brown cane good of Chaku type, meeting all the specifications that are mentioned here, can be delivered at Muzaffarnagar. And here comes the launch calendar. In December, we are going to launch uh, contracts of Jan 2020 21, Feb 21, March 21, April 21, and May is not. This is not a continuous contract now. So May uh, breaks the chain between the both the seasons, and in Jan July contract exists, and so this is the uh, calendar launch calendar of the good. And apart from this, you every investor have to know what are the guidelines that they have to follow, and what they shouldn't follow while investing. So investors should definitely read SEBI or exchange circulars available on exchange before trading, and trade should happen only with the exchange registered member. Fill your KYC mandate, and always code for your unique client code, because every client has a unique client code. Insists on rights and obligation and risk disclosure document. Insists on bill or contract notes for every settlement which are given by the clearing corporation, and ensure that the contract note contains all relevant information such as member registration numbers, order details, trade rate, quantity, and arbitration clause. Cross check the trade genuineness with your trade verification facility available on exchange platform, and pay required margin, that is initial margin and mark to margin obligation in time in order to avoid any penalties. And be aware of risks associated with dabba trading. Reconcile the statement of transactions from member and holding statement of depository participant after every transaction. In case of any discrepancy, voice the same immediately. And issue account payee check or demand draft only in the name of broker, not with the authorized person or anybody else. Insist on periodical statement of accounts of funds and securities from broker. And funding from unauthorized intermediaries are are not covered under settlement guarantee mechanism of exchange, so be aware of it. And investors shouldn't deal with unregistered intermediaries. Don't undertake the off market transactions. Don't get carried away by alluring advertisements or rumors or tips. Don't start trading before undertaking the risk disclosure document. Don't accept unsigned or duplicate contract notes. And don't fall prey to market rumors or any guaranteed returns, and don't risk beyond your limit or capacity. That's your financial condition. And don't simply go by explicit or implicit promises, that is, yeah, guaranteed returns made by adverse advisors or experts. And don't miss on keep tracking of your financial and contractual obligations. Don't go by the reports or predictions made by various print or electronic media. That's all. Thank you very much. If you have any questions, please go ahead. So thank you. I don't think anybody have any questions. Thank you very much.